Good morning, folks, and welcome back to Almus Market Mornings. We are going into a very important Fed meeting. There's a lot of conversation around this one. Markets pricing a rate cut with certainty, but the party seems to have started before the actual results. It actually reminds me of school exams where we tend to celebrate the exam getting over more than the results. We have seen some more rally in precious metals. Euro has made a new cycle high against the dollar. US equities made another new high. And in this backdrop, let's get a FOMC breakdown from JK. Morning, JK. I think we have discussed this in the past as well, but if you can break down what are the expectations ahead of the FOMC and what would be considered as a surprise and what reactions that could have. Just appreciate your views on that.
Good morning, Swaraj. As usual, FOMC is, I know, always very eagerly look forward to event and markets. All markets' attention will be on that, and this time, it is even more so because Fed will be coming out of a very extended pause on the rate cycle. Last they cut was in 2024, and 9 months they have held the rates steady. Now, while the economy has shown definite signs of weakening, as evidenced by many job reports in the recent months, and also housing sector in a very deep trouble. I think the definite bias for a rate cut, and the market consensus is overwhelmingly for a 0.25% cut. But in the last few days, as I said yesterday also, there have been some leading bankers calling for a hefty cut of 0.5%. This is also probably prompted by the fact that in September 2024, when they started the rate cut cycle, against a market expectation of 0.25%, they cut actually the 0.5%. So that maybe if the history repeats, that can happen. But I think, in my view, Fed will tread cautiously on the rate cut. In fact, yesterday's data on retail sales, which came quite strong, would also show that the economy is not doing so badly. It's only the job market data, which is a leading indicator, perhaps, for a future slowdown. But as of now, economy is not slumping, and with the tariff-related inflation pressures slowly seeping into the inflation data, I think Fed will have to go slow about the rate cuts, and I am in the camp of 0.25%. There should not be a surprise in this regard. However, uh, my attention would be more on what the dot plot would say. Now, in the dot plot, of course, today we'll have at least three doves, Michael Bowen, then Valor, as well as newly inducted Mr. Stephen Miran. All of them would not likely, they will not be able to over power the, median expectation of 0.25% cut, but they definitely can show their dot plot leaning towards more than three cuts by January. So that's the way I would be leaning on. The market would be also looking forward to that. Apart from the economic projections of GDP, employment, and also the inflation. If the dot plot shows more rate cuts than what the market is pricing in currently, near about 3%, sorry, three cuts, that will be the surprise that the market will be looking forward to. However, the market is now fully priced in for a 0.25% cut, particularly in the currencies. And yesterday we did see the dollar index almost touching the year's low, and then the euro actually touching a 4-year high at 1.1879. Of course, we also had other currencies participating in the dollar's weakness, gold also hitting the 3,700 mark almost. Now, that means, 0.24% is well priced in. 0.5% could trigger some more sell-off in the dollar, but as the market is extremely, well positioned for the short side of the dollar, I think we can then see a good rebound. Also, don't forget the fact that in September 2024, when the rate cut happened, uh, from the day of the rate cut, within 2 months, we had seen the yield on the 10-year paper move from 3.59 to 4.50. So don't also forget that US has a larger issue with debt and deficits and a huge amount of debt rollovers that is coming up, and they have to finance the ever increasing debt. So that will keep the yields higher, and when the yields are higher, market will tend to be cautious about selling down the dollar too much. So I am a bit circumspect about the dollar losing immediately too much. Yes, the trend on the downside remains, but perhaps not immediately, too much on the downside. I think in the worst case, I think euro could touch about 1.1950 or 1.20. That's what I am expecting. Now, of course, yesterday's data from Europe also supported a bit for the euro, indirectly seeing the dollar index also slide because the German zoo expectation data was quite good. And the same case for the euro area as well. Eurozone industrial production also was better. These things also supported the euro's rise. Now, other surprise yesterday was some strength in the rupee. Now, all along, rupee has been subdued, underperforming its peers and the dollar index. But yesterday we did see it almost close to 88. As usual in the rupee, the sentiment alone or a view does not matter. It is the flow that matters. And yesterday there was an inflow, a sizable inflow from a corporate that, along with the indications that India and US trade representatives are getting into a discussion, also helped the matters. Overnight there has been exchange of more messages between President Trump and PM Modi, as well as some phone call also reported by the news media. Setting up for at least some progress in the trade talks, not to say that everything will be resolved, but that's also another news that is helping the rupee. One more factor for the rupee was strong rise in the stock index. It was only 0.7% rise, but it also in the process broke above the downtrend line, and it was a good session for the market. We also have had the regulator SEBI relaxing the rules for yeah, FI investment, easing for long-term investors of up to 10 years from FI, and also fast track clearance of their proposals. So maybe we are setting up for some amount of recovery in the stock index as well. FIs have been net sellers in the Indian market for quite a long time. A turnaround there could also be in the supporting factor for rupee. So all in all, I think rupee could also participate in the dollar's further weakness to some extent. But definitely it will not be a runaway strength for the rupee until we see a definite progress on the trade side. So all eyes on Fed, of course. And in less than 24 hours, we'll have the decision out. And in less than 24 hours, we also have two more rate decisions, one by Canada tonight and Japan tomorrow morning. And of course, the Bank of England will be out tomorrow late in the afternoon. Busy Wednesday and Thursday for the markets ahead. Thank you.
Thank you, JK. And of course, when we discuss our podcast tomorrow, things would have become a little bit more clearer as to the direction the FOMC is heading. The consensus is, of course, for a 25 basis point cut, but some leading bankers have also started calling for a 50 basis point cut. That's a story we have been tracking. That's the story asset prices reflecting in the asset prices as well. When we look at the overall scenario of the US economy, though, we have on one side the labor market weakening, which is keeping the Fed on the side of easing, but we also have other data points like the retail sales and inflation also having some pressures due to the tariffs that might keep the Fed cautious and not go overboard with a 50 basis point cut. Our expectation, of course, as JP mentioned, is of a 25 basis point cut. We'll also get an idea from the dot plot and the other economic projections as to where the Fed is seeing the terminal rates as well as the growth and the inflation pictures. We, of course, had the euro strengthen, gold hit the $3,700 mark, and a very good strength in the rupee, which traded close to rupees 88. It was also backed by the fact that we have a very positive sentiment coming in from the equities and some more talks which are happening between President Trump and Prime Minister Modi, which is considered positive. But till the time the trade talks do not get finalized, the downside might be limited for the USD. That's it from us, Phil. Thanks for listening. Tune in tomorrow. We will be debriefing on the FOMC, and that will be a good one. Thanks for listening.